were 76,000. And then we are told that on 31st December 2017, the plan received contributions from the employer of 490,000 shillings and paid out benefits of 190,000. Now, after these transactions, the fair value of the plan's asset at 31st December 2017 were 1.5 million. Then we are told that the present value of the defined benefit obligation was 1,479,200 shillings, and the actuarial losses on the obligation for 2017 were 6,000 shillings. We are also told that the expected return on the plan assets, in bracket the net of investment transactions cost, is 8% per annum. Is 8% per annum. Then we are told that the reporting entity made the following estimates at 1st January 2017, and that is the dividend or the interest income after tax payable by the fund, 9.25%, the realized and the unrealized gains after tax on the plan assets, 2%, and then administration cost, 1%, so you less that from the sum of 9.25 and 2%, and that gives us 10.25%. Now we are required to calculate the expected and the actual return on plan assets. We are also required to calculate any actuarial gain or loss, and we state, forget about the other term to state the required accounting. So the last part should be to calculate any actuarial gain or losses. So let me share the whiteboard. Okay. So now what we are going to do is that, first of all, we must determine the expected and the actual return for 2017. We determine the expected and the actual return for 2017. So expected, are you able to see the board? Yes, members?
Yes.
Okay, thank you, thank you. So expected and actual return for 2017. So to determine this, to determine the expected and actual return for 2017, first of all, we are supposed to get the return on the 1 million that had been held for 12 months. So we get the return. On 1 million. That was held for the 12 months. If you look at our problem, you maybe in our problem, we are told that as at January 1st, 2017, the fair value of assets of the defined benefit plans were valued at 1 million. So that is the return that we want to get. So this return, we are going to determine it at a rate of 10.25, the one that we had been given there. So we multiply 10.25%. So percent means that it is 10.25 over 100 times 1 million. So what will that give us? You can unmute your microphones. Then you tell me the answer. Yes, what will that be? 10.25 times
102,500.
102, 500.
500. Yeah.
Thank you. So the amounts are in shillings. $102,500, and you have multiplied the 10.25% by the 1 million to give us this. Then next is to get the return on now the 490 that was paid. If you look at our problem again, we are told that on 31st December 2017, the plan received contribution from the employer of 490,000 and paid out benefits of 190,000. So we get the return on the difference because the employer paid 490. The employer gave a contribution of 490, and then the plan paid out 190,000 to employees. So it means that now the difference there will be 300,000. So we get the return. We'll now get the return on 490 minus 190. So we have 490 that was paid by the employer. And then the plan paid out 190. So it means that the balance which was there was 300,000 shillings. So the balance was 300,000. Hello? Yes? Yeah? So 300,000. So here now, remember these, if you look at our problem, this plan here, the 300,000 here was, if you look at the time period, I don't know whether you can see it. Now between 1st January 2017 and 31st December 2017, that is a period of 1 year. But now for these benefits, they are compounded. The benefits are compounded on half yearly basis. So half yearly means that they are compounded after every 6 months. So therefore, the percentage that we are going to use here, the 10.25% is for a whole year. So we are going to use now half of now the 10.25. So we are going to multiply the 300,000 by 10.25, which is on a yearly basis, times now half, or times 6 out of 12. So what will this give us? We are doing this because they are compounded on the half yearly basis. Yes, members?
15,375.
So this is 15,375. That's correct. Fifteen 375. So now if you add the two, if you add these two, what will it give us? So that will be the expected and the actual return for 2017. So can you add them?
117,875.
117,875.
875.
Okay. $117,875. Any objection from the other members? Okay, if there is no objection, then we can move on. So that is the how we calculate the. Mute your microphone, Cecilia. So that is how we get the expected and the actual return for 2017. Now the next item is now to get the actual return on the plan assets, the actual return on the plan asset. Now what we will do now is that we will now take the fair value of the plan assets as at 31st December 2017, and then we subtract the fair value of plan assets as 1st January 2017, which we have as 1 million. So if you look at your problem, the fair value of plan assets as at 31st December 2017 is 1.5 million. Then we less the contributions that were received, which were 490,000, and then we add the benefits that were paid. So first of all, what we will do is now to get fair value of planned assets as at December, and that we have fair value of planned assets as at December, which is 1.5 million. So 31st December. So let me just write 12 there. So this is 1,500,000. The amounts are in shillings. Then now we less we less fair value of assets, fair value, let me just write F value of planned assets, but now as at 1st January, and this is 1 million. So we are subtracting this, put it in bracket. Then we also less the contribution that was received we less contribution received. Sorry about that. And the contribution that was received from the employer was 490,000. The contribution received 490,000. We less it. So again in bracket. And then lastly, we add the benefits paid out. We add the benefits that were paid, and the benefits that were paid amounted to 190,000. The benefits that were paid amounted to 190. So can we now get the amount there?
200,000.
200,000. The other members, you can unmute your microphone and confirm whether the value is 200,000 or not. So the 200,000 here will be the actual. So that is 200,000. So that is the
200,000.
You've confirmed?
Yeah.
Okay. So that is the actual return on plan assets. Actual return on plan assets. Remember, we had got the expected return, actual return on plan assets. Actual return on plan assets. The expected return is, we calculated that if you look at our expected return, we got that as 117,875. So to determine whether there has been an actuarial gain or loss, then we compare these two figures. We will now compare the expected return, which was 117, and the actual return, which is 200,000. So maybe if I may ask the members, has there been an actuarial gain or loss, looking at now what was expected and what we have actually found out? So is it an actuarial gain or an actuarial loss?
Again.
Why are you saying that it is a gain? Yes, why are you saying that it is a gain?
Because the actual return is more than what we expected.
What we've got is more than what we had anticipated. So in our case, now we will have an actuarial gain of now the difference. Actuarial gain of now the difference between the two. So you subtract 117,875 from 200. So that will give us what figure? 200.
82,125.
82,125. The other members?
Yeah.
Other members, have you confirmed? Don't
Yeah,
just
82,125.
82,125.
Yeah.
Okay. So that is an actuarial gain of 82,125. $82,125. So any question up to that point? Now we can now say that the cumulative net unrecognized actuarial gain, the cumulative net unrecognized actuarial gain will now be, you will take the 82,500 plus 76,000 minus the 6,000. And I believe you can be able to know where we are getting the 76,000. If you go back to the problem, we were told that the net cumulative actuarial gains and losses were 76,000. That is as at 1st January 2017. Then now we add that to what we have found out now, which is 82,125. And then we subtract now the 6,000. And this 6,000 we have been told in the second last line, we were told that after these transactions, the fair value of the planned assets as at 31st December 2017 were 1.5 million. The present value of the defined benefit obligation was 1,479,200, and actuarial losses on the obligation for 2017 were 6,000. So we subtract the losses from the gains. So we can say that now the last item now in that question is to get the cumulative net unrecognized actuarial gain, cumulative unrecognized actuarial gains, unrecognized actuarial gains. So this will get by taking the 76,000 now plus the gain that we found during the year, which is the 76,000 was now or the gains as at 1st January 2017. And then we add the gains during the year, which is 82,125 less the losses at the end of the year, which were 6,000. And that will give us now the cumulative unrecognized actuarial gains for this particular year. So that will give us how much?
152, 125.
Yeah?
152.
125.
Is it 142 or 152? Which one is which?
152, 125.
152, 125. Confirmed?
Yes.
Yeah.
Joram is here and is not talking. Joram, are you here? Joram Jenga?
I am.
Okay, thank you. Are you okay with that?
I'm okay.
Okay, thank you.
I'm okay.
Okay, so any question in that question on the plan assets? Any question? Okay, so silent means we are okay. So that is what was expected of us in that question. Then now the next item and the last item on this topic is to look at the curtailments and settlements. Curtailments and settlements. So can rub our board. Curtailments and settlements. Cecilia, mute your microphone. So the last item is curtailment and settlement. Curtailment and settlement. Now, curtailment occurs when an entity cuts back on the benefits that are available under a defined benefit scheme, so that there is either a significant reduction in the number of employees eligible for the benefits, or that there is a reduction in the post-employment benefits that will be given to the employees. So you can do it by either reducing the number of employees, or you can reduce the amount that each employee now will receive at the end of the period or at the end of their service. So that is what curtailment is all about. Either you reduce the amount that is paid for each employee, or you reduce the number of employees that will get the benefits. So that is what curtailment is. And when it comes now to settlement, a settlement occurs either when an employer pays off. It occurs when an employer pays off its post-employment benefit obligations in exchange for making a lump sum payment, or when an employer reduces the number of post-employment benefits, the number of post-employment benefits, post-employment benefits that is payable in future in respect of past service. Now, a curtailment and settlement might happen together at the same time. For example, when an employee brings a defined benefit plan to an end by settling the obligation with lump sum payment and then stamping the plan. So that can happen, so that now instead of, for example, if you are to pay equal installments in maybe 14 months, and then maybe after 10 months, you find that you want to maybe leave your position at a particular company that is providing the benefit. So you may decide that now, instead of waiting for the 40 at the end of 14 months to get my benefit, why can't I now settle the other 4 months in advance? So you pay them in advance, and then now the employer or the scheme will pay you the total amount that you have invested with them. Now, the gains or the losses that are arising from curtailment or settlement of a defined benefit plan should be recognized in full in the financial year that they occur. It should be recognized in full in the financial year that they occur. So in such a case now, the gains and the losses may comprise of: one, any change in the present value of the future obligations of the company as a result of the curtailment, and two, any change in the fair value of the plan assets as the consequence of curtailment or settlement. And therefore now the companies or an institution should therefore remeasure the obligation using the current actuarial assumptions before determining the effect of curtailment or the settlement. So you will always be given the actuarial assumptions, the percentages that you are to use in each and every case that you may encounter. So to explain that well, we can go to the question that is involving Hosan Company, so that we get to understand the curtailments and the settlements better. So if you have downloaded the notes, we go to the question on the Hosan Company. So I can read it again. Hosan Company discontinued a business segment. Then we are told that the employees of the discontinued segment will earn no further benefits. Then in bracket, we are told that this is a curtailment without a settlement for that case. Then we are also told that using the current actuarial assumptions, in bracket, including current market interest rates and other current market prices, immediately before the curtailment, the Hosan Company had a defined benefit obligation with a net present value of 500,000 shillings, plan assets with a fair value of 410,000 shillings, and net cumulative unrecognized, net cumulative unrecognized actuarial gains of 25,000. Then we are also told that the entity had first adopted IAS 19, that is revised 1 year later. So these increased the net liability. These increased the net liability by 50,000, which the entity chose to recognize over 5 years. Then required, we are told to show the required treatment for the curtailment. the required treatment for the curtailment. So that is what we have to help us now understand curtailments and settlement better. So what we need now to do, the first thing is to get the previously unrecognized actuarial gains amounts that really will give us now the percentage that was used. So we can get the percentage from there. Remember, we have been told that if you look at the problem, we have been told that before the curtailment, immediately before the curtailment, the Osan company had a defined benefit obligation with a net present value of 500,000. That is the net present value. But now out of this, we have been told that if you read the last line, that it increased the net liability by 50,000. So if we use the 50,000 and the 500,000, we can be able to get the actuarial gains amounts which relates to the part of the obligation which was eliminated through the curtailment. So the first item now, the solution for this problem, the first item is to get that percentage. So we get the unrecognized actuarial gain percentage. Unrecognized actuarial gains. So remember, we are getting this by now dividing the 50,000, the reduction in the ability, by the present value, which is 500,000. So what will this give us? What will that give us as a percentage?
0.1.
0.1 as a percentage. As a percentage, you multiply 0.1 by 100, and that is 10.
10.
10%, isn't it?
Yes.
Other members? Belinda? Yes? Joram? We have Albert?
10%.
10%. Okay, thank you. So that is 10%. And now the that 10% relates to the part of the obligation that was eliminated through the curtailment, because that is after the curtailment. Now the net liability increased by 50,000 shillings. Now we now need to get the effect of the curtailment. The next item is to get the effect of the curtailment. Effect of the curtailment. So this we will get in form of a table. So we are going to have 4 columns. So the first column, you can leave it blank. So I think we can do it on this other side. So the first column, just leave it blank. So the second column, we have before curtailment. Before curtailment. Then we have curtailment gains. Curtailment gains. And then lastly, the last column is after curtailment. After curtailment. Yes, so those are the 4 columns that we are using. So the first item that I want us to have is the net present value obligation. Net present value obligation, NP obligation. Then remember the amounts here, we are going to have them in thousands, so that we don't have to write so many zeros. Please let us mute our microphone when we are not talking, or you use a earphone to avoid the background noise. So the first item is net present value obligation. Net present value obligation. So before the curtailment, we were told that now the net present value was 500,000. So that is 500 from the problem. Then we had a liability there of 50. So curtailment gain, there was a liability of 50. So the liability now we subtract it from the 500. So that gives us 450. Are we together in that? Any question up to that point?
No, we are together.
Okay, next we look at the fair value of the plan assets. Fair value of the plan assets. These we have been given as 410. Fair value of the plan assets, 410. There was no effect, so there is no gain, no loss. So after curtailment, that value still stands at 410. So we subtract it now from the net present value obligation. So if you subtract this, here we'll have 90, the difference there. Here we have 50 minus 0, that is 50. And still it is negative. Then here, after curtailment, 450 minus 410, that is 40. So as you can see, we can also get this 40 by just subtracting the 50 here from the 90. Then we move to the unrecognized actuarial gain. Unrecognized actuarial gain. Which we have been given in the problem. If you look at our problem, unrecognized actuarial gain. So if you look at our problem, for those who have not yet downloaded the problem, we were told that the net cumulative unrecognized actuarial gain was 25,000 shillings. 25,000 shillings. So that is 25,000. So we write 25. Remember, our values here are in terms of thousands there. So that is 25. Then to get the curtailment gain or the loss there, we use the same percentage that we had calculated before, which is here, the 10%. So we'll have 25 times 10%, 25 times 10 over 100. So what will that give us? 2.5.
2.5.
Correct, yes. 2.5. So what will be now the amount after curtailment? So you subtract 2.5 from 25, and that gives us 22.5. 22.5. Any question up to that point? Any question?
Yeah, repeat.
From where? From the beginning, Ama?
No, this question we are answering now.
Yes? Or the one that
The
we are looking at now?
Yeah,
So first of all, we wanted to get the actuarial assumption or the percentage that we are going to use. So we've got that by dividing the 50,000 by the net present value, which was 500,000, to give us the percentage of 10%. So this is what we assume that we are going to use now to get the actuarial gains and losses for the amounts that we are going to have. So once you have done that, because we were not given this percentage as like in our first case. So you have to calculate it using the amounts that you have been given. Then after this, we are trying to find out the effect of the curtailment now on the net present value and also the fair value of the plan assets. So what we have done now, we've made a table which has got 4 columns so that we write the amounts before curtailment, we note the curtailment gain, and we also note the amount after the curtailment. So the first item has been the net present value obligation, which was before curtailment, we had 500,000. That is what we have in our problem. Then now we get the 10% of the 500,000 for the curtailment gain. But in our case, you find that now the 50 is a liability from the problem. So it means that it is not a gain, but a loss. That is why we are having it in bracket, because it is a loss. If it would have been a gain, would have added it to the net present value before curtailment. So if you subtract the 50 from the 500, then after curtailment, the net present value now will not be 500, but it will be 500 minus 50, which is 450. Then we go to the fair value of the plan assets. Now, for the fair value of the plan assets, if you look at our question, then you find that now for the fair value of the plan asset, the amount was 410, and that amount we just note it the way it is, but we subtract it from the net present value obligation. So for the curtailment, we have not been told about the amount that increased or decreased, so that is why we have left it blank. And then now the total amount here will still be 410, because there is nothing that we have added or subtracted from the amount. So from these two figures, the net present value and the fair value of plan assets, we have deducted the fair value of plan assets from the net present value obligation. That is why we are getting the 90 here, and then negative 50 minus 0 still becomes a negative 50. Then 450 minus 410, that gives us the 40,000, or just 40, because these values here, all of them are in thousands. So that was that. Then we have gone now to unrecognized actuarial gain. Now, if you go to our problem, the last paragraph, we are told that the net cumulative unrecognized actuarial gains were 25,000. So that is what we have here, unrecognized actuarial gain, 25,000. But since now the actuarial gains were for the year, we need now to work out the curtailment gains or the losses by using the same percentage that we had got before, the 10%. So we multiply 10% by 25, that gives us 2.5 thousand, or just 2.5. Remember, all these amounts are in thousands. So if you subtract 2.5 from 25, that's where we are coming with the 22.5 that we have there. So I hope we are together up to that point, unless there is any other item that you want me to look at again.
No, I've understood.
Okay.
Yeah.
Okay, thank you. Now from from here, we need to add all these amounts for us now to get the net liability that is to be recognized. So you just add this plus this, you get an amount there. You add this plus this, you get an amount there. then you add this plus this, you get an amount. Yes, what will that give us? The first one, 90 plus 25.
115.
Yes,
115.
115. And then for this other one is negative 52.5.
52.5.
Negative, not positive.
Yeah. Yeah, negative 52.5.
Negative 52.5. And then here,
62.5.
you can also get it by just subtracting this from,
Yeah.
So,
Oh.
yes, 62.5. So that we can also get by just subtracting the curtailment gains from the total before curtailment. So you will find that maybe in some textbooks, they'll not use this column here, but now once they have reached at this stage, they'll have now, they'll now subtract the difference between now this from this. So in some books, if you find them not having our last column there, you should not be worried. I just included it for us to also see the amounts after curtailment in every stage, but it is not a must that you have that third column. I hope we are clear. So in some books,
Yes.
they just have the two columns, the before curtailment and then the curtailment gains. But after they have reached this stage here, they now come and subtract 52.5 from now 115 to get 62.5. But for ours, once you have reached this stage, it is just okay. It is just okay with this. You don't have to go to the last stage. So the amount that we've got there is now the net liability. The net liability, and that is to be recognized in the balance sheet. I hope you still remember balance sheet, or you have forgotten. Yes, members? So the last one is the net liability recognized in the balance sheet. Recognized in the balance sheet. Any question up to that point? Any question?
Yes.
Yes, any question?
The definition of curtailment, please.
Oh,
Never
curtail.
understood.
Okay. Now we have curtailment and settlement. Now, curtailment occurs. It occurs when maybe a company decide to reduce the benefit to the customers. That is the first case. They reduce the amount of benefits to the members, or they can decide, assuming that a company is having 10,000 employees, 10,000 employees. Curtailment can occur in two forms. In simple English, it means to cut back. To cut back. So assuming that an organization has got 10,000 employees who are benefiting from a defined scheme, they may decide that now out of these 10,000, assuming that the 10,000 are composed of both permanent, consisting of both permanent, and then the employees on contract, they may decide that now we are now not going to retain the contract employees on the scheme. So let's take, for example, that the contract employees were 1,000. So they may decide to cut this 1,000 from the scheme. So the number of employees that will be there will be 900. They have 9,000. They have reduced the number of employees. That is the first case. The second case is where now the company is deciding to reduce the amount. So maybe if an employee would have been entitled to 10% of his or her basic pay for the number of years that they have been in service. So for curtailment in this form, the company may decide that now, because maybe we are not financially stable and so on, they may decide to reduce this amount to 8% or to 9%. So in this, if they reduce this to 8%, it means that the amount of money that the employees will take home will be less by 2% of each and every employee's basic salary. So curtailment in simple English, it simply means just to cut back. So a company may decide to cut back on the number of people who are required to benefit, or they may decide to cut back on the amount now that is due, the amount that is due for each and every employee. I don't think if we are together. Are we now okay?
Yes, I've understood.
Okay, so that is what is curtailment is, yeah? But settlement is simply to pay off. Settlement is simply to pay off. Paying off, that is what we mean by settlement. Curtailment means cutting back. You cut back on maybe the number of employees or on the amount that is to be paid. So any other question? Members?
Yeah, explain plan assets.
Yes?
The meaning of plan assets.
Oh, the meaning of plan assets. Now,
Yeah.
now plan assets, let me try to find a word. Now, the plan assets, if for example, we have a company, and this company has got employees. So nowadays, the employer alone does not invest for retirement of their employees. They have what we call a defined benefit plan or a defined benefit scheme, which is simply an arrangement between both the employer and the employee. So both of them agrees to contribute towards the retirement of an employee, so that the employee continues with his lifestyle even after employment or post-employment. So for example, you may find that an employer agrees to be contributing to the scheme, contributing maybe 10% of the basic salary of each employee to the scheme, and then the employee may contribute 7% again of its basic salary towards the scheme. Now, this money is collected by the employer at the end of every month. It is collected by the employer at the end of every month. So 10% of basic by the employer, 7% by the employee, and then it is channeled to a fund or a scheme. Now we have pension, we have organizations called the pension fund managers. Pension fund managers, there are very many. For example, we have the Octagon Africa in Kenya. So this money is given to the manager, the pension fund manager. Now, when this money is given to the manager, they don't just keep it in an account somewhere, in a bank account. What they do is that they will take that money and invest it in maybe the real estates. They can also invest it in stocks. They can invest it in shares, various investment opportunities that are available in maybe our country, Kenya. So these are now the assets that we are talking about as being the planned assets. Remember, these assets here, the money that has been used to invest here is the money that is contributed by the employee. Remember, even this 10%, it is not the employer just contributing for itself, but contributing on behalf of the employee. So this helps even the employers now to manage the post-employment for their employees. So that is what a plan asset is. So the money is contributed both by the employer and the employee, given to a pension fund manager. The pension fund manager now will take that money and then invest it in the assets. So those assets that are invested in, those are what we call now the plan assets. Remember, the pension fund manager invest the amounts on the plan assets on behalf of now the employees. They invest on behalf of the employees. So any question or any clarification again that is needed?
I'm okay.
Okay.
Yes.
Okay, thank you. Now, I think if there is no any other question, we can now stop there for our live session on the Zoom platform. But now we go back to the ZDS platform, and there will be a discussion forum there, just a question, a short one. Please ensure that you participate, because I realize that some of you are not participating. Some of you are not participating. So please make sure that you participate in our discussion. So ending this session, and we are going back to the ZDS platform. So thank you for today. I think we'll meet next time.